value always gives this impression about finding a company that the market has not given or ascribed the right value to. How do you find a truly valuable company that pretty much everyone else is overlooking? Maybe your process.
Yeah, sure. See, I classify value into two buckets, right? The first one is pure value. Say a company with a dividend yield of 5%, company trading half-time book, or various metrics, which was what was propagated by the original value investors, whether it was Warren Buffett initially or Graham, 70, 80
Yes.
years
Yeah.
back. But the difference between then and now is that 50 years back, there existed a huge information arbitrage.
Yeah.
Like, for example, when I started my career in 2002, you would also recollect annual reports were very hard to get by.
Yeah.
You had to go to a raddiwala or you had to be an investor to get an annual report. And obviously, you are the first one to read an annual report. You will have access to some more data which the general public may
Does
not have.
not. Yeah.
So you would act on that. So a company may look very cheap because there would not be information available. You would act on it and make money. Today, that's not the case. So whether I'm an investor, whether I'm an investor managing 10,000 crores or whether I'm a retail investor with 10,000, that annual report, presentation, podcast of the company's earnings, it's available to everybody.
Everybody.
So I don't get any special information edge apart from whatever my technical expertise is.
Yeah.
So I think that arbitrage is gone. So if one was to take a bet on that bucket, that okay, this is at 5% yield, this is at 10% yield, you have to assume that the markets have looked it and given it a pass.
Okay.
So it could be a case, for example, there is a market where, very inferior quality apples are being sold. It is inferior.
Yeah.
You have to maybe ride on your luck to pick the right one and make money. So that is one source, but not a very big source for me. But the essential thing that I would look out for more than a yield or a price to book is that what is it that can surprise the market? Like, for example, if I were to take exposure, say, in a mining company or in an in a oil exploration company, obviously the yield is attractive. But if I'm convinced that there is going to be the growth in, say, an iron ore mining or copper mining or in the oil or gas production, which the market is not anticipating or market is not expecting, that would be an additional source of alpha for me.
Nice.
So that would make me look at that stock more favorably, but not the absolute yield, 5% yield or 6% yield. Coming to the first part, which is where, most of my portfolio resides, that again, I would subdivide into two. See, one thing I found in the last, maybe 7-8 years is that even for very well-established companies, it has its own valuation cycle. Like if you take the last 10 years, ITC has even traded at 15-16 times and 5% dividend yield.
Correct.
Today, probably it trades at 25 times. It is traded at 30 times.
Yeah.
So if you make an entry at 15 times and exit at 30 times, there's a huge alpha that you have made.
Yeah.
Right? Same thing goes with a company like, say, an Infosys or an HDFC Bank or a Sun Pharma. They go through their own challenges.
Yeah.
And today, the nature of the market is such that some part of the market is momentum driven. So obviously, when things don't go well for a well-established company, you would find that people turn negative, more shorts happen, it moves out of certain indices. So that gives a huge opportunity to a person like me to look at it from a longer term time frame.
Oh, nice.
But yes, it's an anti-momentum. I have to wait for some time. And in my mind, I assume that I buy a stock like this, I should expect a 5%, 10% fall. Otherwise, it can't be that I start and then it just gallops. No.
Yeah.
But that's a very good way of making long-term money, because most of these companies, if you see, they recover. And these are all well-established. I mean, if you look at the top 10, whether it is Bharti, whether it is Sun, they may go up and down in a 3-year, 5-year, but in a very long term, they deliver very solid returns.
Okay.
So if you're able to pick it up when they are at the bottom of their cycle, it gives you outsized returns. The second one, what I would call for is a lot of mid and small caps are generally underpriced.
Okay.
Some of them could be turnaround cases. Some of them could be cases where the market is not, has a bad memory. It has underperformed in the past. There's a change in management. There's a change in the business model. That's another way of kind of making alpha. So these are the two broad buckets of value that I would look out for.